All right, today we're going to crack open a really important tool. It's for understanding some of the most exciting and, let's be honest, most confusing companies out there. The high growth, disruptive innovators that haven't actually turned a profit yet. So let's kick things off with a big fundamental question. How in the world do you figure out what a company is worth when it isn't making any money? I mean, think about it. The classic price to earnings ratio, the famous PE, it completely breaks down. It's like trying to divide by a negative number. The math just falls apart. So, where do we even begin? Okay, so the answer is actually pretty simple. We just shift our focus. Instead of looking at the bottom line, profit, we're going to look at the top line, sales. And the tool that lets us do that is the price to sales ratio, or as you'll often hear it, the P/S ratio. The great thing about the PS ratio is how simple it is at its core. It just asks one question. For every single dollar a company rings up in sales, how much are investors willing to pay for a piece of that company? We're looking at revenue, which is a lot more stable and, frankly, a lot harder to fudge with accounting tricks than earnings are. And calculating it? Super easy. There are actually two ways you can go about it, but don't worry, they both give you the exact same answer. You can take the company's total market value, its market cap, and divide that by its total annual revenue. Or you can just take the price of a single share and divide that by how much revenue is generated per share. Either way, you get to the same number. Okay, so we've got our number. Now what? What does this thing actually tell us? Let's dive into how to read this ratio. So here's the general rule of thumb. A lower P/S ratio might mean you've stumbled upon a bargain. You're not paying very much for each dollar of sales. On the flip side, a higher ratio could suggest the stock is a bit pricey. Or, and this is key, it could mean that investors are expecting absolutely massive growth down the road and are willing to pay up for it now. But, and this is a huge but, on its own, that number tells you almost nothing. It's totally useless without context. And that right there brings us to probably the single most important rule when you're using the PS ratio. Context is everything. A ratio floating in a vacuum is completely meaningless. This quote just nails it. It's the golden rule of PS analysis. You simply cannot compare an airline to a software company using this metric. It's apples and oranges. And why is that? Because their business models are worlds apart, and their ability to squeeze actual profit out of a dollar of sales is completely different. Okay, let's make this real. Take a look at this. The average company that makes computers and peripherals has a P/S ratio of about 6.46. That means investors are paying almost $6.50 for every $1 of sales. So why on earth would they pay such a huge premium? Now hold that number in your head and look at this one. The airline industry has an average P/S of just 0.55. So here, investors are only willing to pay 55 cents for that exact same dollar of sales. What gives? What makes $1 of sales so much more valuable than another? And here's the answer. This table lays it all out for us. It all comes down to profitability. See that high PS for the computer industry? It's supported by a really healthy 16.78% net profit margin. Now look down at air transport. That super low PS ratio reflects their razor-thin 2.21% margin. So the PS ratio is really a shortcut. It's a reflection of the market's belief in a company's ability to turn sales into real profits later on. And check out that fascinating outlier, biotech. Investors are paying a high price for those sales even though the average margin is negative. Why? Because they're making a huge bet on a future blockbuster drug that could change the entire game. Okay, so the PS ratio is clearly a powerful tool. But it's not perfect. It's got a couple of major blind spots that you absolutely have to be aware of. So blind spot number one, and it's kind of ironic because the ratio's biggest strength is also its biggest weakness. By focusing only on sales, it totally ignores whether the company is profitable. You could have a business with amazing sales growth that looks cheap on a PS basis, but it could still be losing a ton of money on every single thing it sells. And the second blind spot, well, this one can be even more dangerous. And that's debt. The PS ratio only looks at the stock value, the market cap. It tells you absolutely nothing about the company's balance sheet. You could be looking at a company that is drowning in debt, and this ratio wouldn't give you a single warning sign. So, what's the fix? How do the pros get around this debt problem? Well, they upgrade their toolkit. They use a slightly more advanced metric to get a much fuller picture. This is where a metric called enterprise value to sales, or EV to sales, comes in. Now, enterprise value is just the company's market cap plus all its debt minus the cash it has on hand. Think of it as the price you'd pay to buy the entire company, lock, stock, and barrel, including its debt. By using EV instead of just the stock price, you get a much more complete view that accounts for debt, and it gives you a much truer comparison between different companies. So, what's the big takeaway from all this? It's that the price to sales ratio isn't some magic formula that gives you a final answer. It's a fantastic screening tool. It's your starting point. It helps you quickly put a value on those companies without profits and compare them to their peers. But it's the beginning of your research, not the end. It's designed to help you ask better, smarter questions. And really, that gets to the heart of what good financial analysis is all about. It's not some treasure hunt for a magic number that screams buy or sell. It's about building a deeper, more thoughtful understanding of a business. The PS ratio doesn't give you the answer. It gives you something much more valuable. It gives you the right questions to ask next.